In February of 2026, missiles crossed the Persian Gulf, and the price of jet fuel nearly doubled. Every airline in America started bleeding, and I want to be honest with you from the first sentence. So did this one. But when Delta Airlines opened its books that quarter, there was one line on the page that nobody else had. A single asset quietly handing back $300 million for exactly one reason: because fuel had gotten expensive. That didn't make them immune. Nothing makes you immune to a war. It made them the only airline in this country standing on the other side of the trade. Because Delta owns an oil refinery. A real one. Steel, pipes, fire, sitting on the Delaware River in Trainer, Pennsylvania. That's not a metaphor, that's an address. And here's the part that stopped me cold. That refinery wasn't a CEO's idea. It didn't come out of a boardroom or a strategy deck or a consultant's slide. It came from one man, a trader. And a few years after he handed it to them, the regulators banned him from the financial markets for life. Almost nobody says his name, so let's start there. To understand why a passenger airline would ever buy a refinery, you have to understand what fuel had already done to Delta. Twice. In 2005, Delta filed for bankruptcy. $28 billion in listed debt. And what pushed it over the edge was the price of a liquid. Fuel was its largest cost, and the company had almost no protection from it. An analyst put it in a way that still lands. Every 1 cent increase in the price of jet fuel cost Delta $25 million a year. 1 cent. You can't run a business on that. You can only survive it. So Delta did what everyone else did. It went to Wall Street. It bought hedges, paper contracts designed to protect it from the next spike. And in 2009, those contracts cost the company $1.4 billion. Sit with that for a second. They bought insurance against the fire, and the insurance burned down too. Most companies would have learned the small lesson there. Hedge less. Be careful. Delta learned a different one, and it's the reason this story exists. They decided the problem wasn't the size of the bet. The problem was that they were betting inside a market they didn't own. Which brings us to a man named Jon Ruggles. He came from a world most airline executives never touch. Merrill Lynch. Then Trafigura, a Dutch commodities house. The kind of firm that doesn't sell you anything, doesn't build anything, and quietly moves a meaningful share of the world's oil. And in early 2011, Delta's chief executive, Richard Anderson, hired him to fix the fuel desk. Anderson is worth pausing on because he doesn't fit either. He was a lawyer, a former prosecutor from Texas, no business degree. He'd come up through Northwest Airlines and then run a health insurance company. And now he was running an airline that had been humiliated by oil twice in a decade. A prosecutor hiring a commodities trader to defend an airline. According to reporting from that period, Ruggles got a signing bonus of $1 million. An airline paying a Wall Street signing bonus to a man who would never touch an airplane. And what he built inside that company was not a hedging department. Let's be honest about what it was. He put in Bloomberg terminals. He opened accounts on the Chicago Mercantile Exchange and on the Intercontinental Exchange. He cut out the middlemen and started trading directly with the giants, with Cargill, with Coke. He hired more than 20 traders. He gave the desk its own name. He built a hedge fund inside an airline, and in the first year, it worked. Delta reported $420 million in gains from derivatives. There's one trade in particular that people who were around still talk about. Late in 2011, Ruggles made an aggressive bet in the heating oil market. Reporting from the Times suggests it brought in somewhere in the neighborhood of $100 million, and it landed at exactly the moment the company was tight on cash. The story that trailed it around, and I want to be careful here, because this is a report and not an audited fact, is that the trade effectively covered the bonus checks. An airline paying its people with a bet on the price of oil. A trader at Goldman Sachs later described how the market saw him, and there was no affection in it. From day one, he said, everyone thought the guy was a lunatic. Hold on to that word. You're going to want it later. Because in the spring of 2012, Ruggles proposed something that wasn't a trade at all. There was a refinery in Trainer, Pennsylvania, 90 years old. Phillips 66 had shut it down the previous September because it wasn't earning enough to justify keeping the lights on. A dead asset, a carcass on a riverbank. And Ruggles said, buy it. Not a contract on fuel, not a bet on fuel. The place where fuel is made. Delta paid $180 million, put in roughly another $100 million to retool it. Pennsylvania added a grant of $30 million to save the jobs, and Anderson stood in front of the press and said something that sounds almost modest now, that the whole thing cost about what one new wide-body jet costs, and it would cut their fuel bill by $300 million a year. The industry's reaction was immediate. They laughed. They laughed for a reason. Refining is a brutal business. Thin margins, old steel, environmental liability, and a cycle that eats amateurs alive. Phillips 66 was not a naive company. They had every engineer, every trader, every model. And they closed Trainer because the numbers didn't work. And now here comes an airline, to pick up the thing a professional oil company threw in the trash. And for a while, the laughter looked earned. The first full year under Delta, that refinery lost $116 million. Not made, lost. But that's not the part of this story I keep turning over in my head. The part I keep turning over is what happened to the man. By the second half of 2012, the trading book was in trouble. Positions had moved against him, and Ruggles was in conflict with management, the same management that had handed him $1 million and a blank sheet of paper 18 months earlier. He left at the end of that year. No press release, no farewell. The architect of the whole thing just walked out of the building, and the building kept standing. And for 4 years, nothing happened. And then the regulators arrived. In June of 2016, the CME Group, the exchange itself, banned him from its markets permanently and fined him more than $3 million. Their finding was specific. At least 82 trades placed in an account registered in his wife's name. Trades that, in the exchange's words, opposed or offset orders belonging to Delta. Orders he was placing on behalf of his employer. 3 months later, the Commodity Futures Trading Commission finished it. Disgorgement of $3.5 million. A civil penalty of another $1.75 million. $5.25 million in total. A permanent ban from the industry. The regulator's language was blunt, fraudulent, fictitious, non-competitive trades, in crude, in heating oil, in gasoline, using confidential information belonging to the company that employed him. That's the accusation, and it's a serious one. Now I want to slow down, because there are 3 facts here that almost nobody reports. And each one makes this harder, not easier. The first, he never admitted guilt. The settlement was entered, as these things are, neither admitting nor denying the findings. The second, he was never criminally charged. Not once. No indictment, no trial. No jury ever heard any of it. And the third, this is the one that sits in my chest. Delta never took legal action against him. The company that the regulators said he had traded against, that had, in their telling, been the counterparty to his own private book. They never sued him. They kept the refinery. He kept the ban. And I don't know what to do with that. I've read everything I can find, and I still don't know. Because there's a version where he's simply a man who got greedy, who sat on top of the biggest fuel buying operation in American aviation and couldn't resist running a little book on the side. That version is ugly, and it is entirely consistent with the record. But there's another version, one where the same instinct, the appetite, the certainty, the total inability to sit still while a market moves, is the exact thing that made him look at a 90-year-old corpse of a refinery and see a fortress where you don't get one without the other, where the flaw and the gift were never two things. The market called him a lunatic on the first day. They were half right, and nobody has ever really decided which half mattered. So by 2013, here is where Delta stands. They own a refinery that lost $116 million. They own it on the advice of a man who is no longer there, and who is about to become radioactive. Wall Street thinks they're idiots. The oil industry thinks they're tourists. And the great vindication, the day the world catches fire and the whole thing finally makes sense, is still 14 years away. 14 years. Nobody tells you about those 14 years. They're the most important part of the story. Here's what nobody tells you about being right too early. It looks exactly like being wrong. There's no medal for it. No one comes to the door and says, "Hold on, you're going to look brilliant in a decade or so." You just sit there, year after year, watching the thing you built get described in public by serious people as a mistake. That was Trainer. The refinery didn't fail, that's the thing. If it had failed cleanly, burned to the ground, gone bankrupt, been sold for scrap, Delta would have taken the loss and moved on, and this would be a very short video. Instead, it did something worse. It just sort of hovered. Some years it made a little money. Some years it lost a little. It swung with the market, unpredictable, never quite delivering the clean $300 million in annual savings that had been promised on that stage in 2012. It was a machine that required constant attention and returned no obvious reward. And that is the hardest kind of asset to own. Not the one that kills you. The one that just sits there, quietly costing you your credibility. By 2018, Forbes ran a piece calling the refinery Delta's one big mistake. Not a mistake, the mistake. 6 years in, and the most generous read available in the business press was that the smartest airline in America had made one unforced error, and this was it. And here's the detail that tells you Delta knew it. There were reports that the company went looking for a partner, someone to take a piece of it, to share the burden, to share the risk, to put another name on the door so Delta didn't have to stand there alone, holding an oil refinery it couldn't explain to its own shareholders. Nobody wanted it. Read that again. They tried to sell part of it. And the market, the same market that would one day call this the smartest asset in the industry, said no thank you. So they were stuck with the steel, stuck with the ridicule, stuck with the ghost of a man they couldn't even name out loud anymore without a lawyer in the room. And they held. Now, why did they hold? To understand that, you need one idea, just one, and it takes about 90 seconds. It's called the crack spread. Crude oil comes out of the ground as one thing. It goes into a refinery, and it comes out as many things: gasoline, diesel, heating oil, jet fuel. The crack spread is simply the gap between what you paid for the barrel and what you can sell the pieces for. That's it. That's the whole idea. Now here's why it matters. In a calm world, that gap is narrow. Refining is a grind. You make pennies. That's the 14 years. That's trainer, hovering, breaking even, embarrassing everybody. But when the world gets frightened, when missiles fly, when a strait closes, when tankers stop moving, something specific happens. The price of the finished product runs harder and faster than the price of the crude. The gap widens. The spread cracks open. And in that moment, the airline flying the plane gets crushed because it has to buy expensive fuel. But the owner of the refinery gets paid because it is the one making the expensive fuel. Do you see what Delta was actually holding? Not a fuel supplier, not a cost-saving measure, not a clever hedge. They were holding the only asset in American aviation that pays you more the worse the world gets. They didn't buy a refinery, they bought a lottery ticket on catastrophe. And they had to hold that ticket, in public, being laughed at, for 14 years. I think about the meetings. Every quarter, some analyst on the call asking, politely, when Delta was going to get rid of the thing. Every year, some columnist filing the same piece. Every board meeting, someone asking whether it was time to just take the loss and be done. And someone in that room had to say, no, we keep it. Not because they had proof. They didn't have proof. Because they had a memory of 2005 and of 2009. They kept it the way you keep a fire extinguisher. You feel a little foolish paying for it, dusting it, every single year that nothing burns. And then, something burns. February 2026. Missiles cross the Persian Gulf. Tankers turn around in the Strait of Hormuz. And the price of jet fuel in the United States runs past $4.80 a gallon at the peak. Roughly double. And every airline in America opens its books and finds a hole. Delta finds one too. I promised you honesty in the first minute of this video, so here it is. Delta paid over $4 billion for fuel in a single quarter. Their average price hit a record, $3.93 a gallon, against about $2.25 a year earlier. Their profit fell by a quarter. They bled. But down at the bottom of the page, on a line that no other airline has, there was $300 million coming back the other way. The chief financial officer's language was careful, and I want to use his word, because it's the honest one. He said the refinery would partially offset the higher crack spreads. Partially. That's not immunity. That's a tourniquet. Delta didn't win the war. Delta figured out how to bleed slower than everyone else. And in an industry where the survivors are simply the ones who bleed slowest, that is everything. Even the chief executive of United Airlines admitted it out loud. A rival, a man with no reason to be generous. With the crack spread this high, he said, they'll get a real benefit, and it will be unique to them. Unique to them. The lunatic was right. So that's the happy ending. 14 years of ridicule, vindicated. Roll credits. Except, that same summer, Delta's chief executive, Ed Bastian, sat down with CNBC and said something that almost nobody flinched at. He said the company had already passed roughly 60% of the higher fuel cost onto its customers, and that it expected to get close to 100% in the current quarter. 100%. Now hold that next to the other number, the 300 million a quarter the refinery was throwing off, precisely because fuel had gotten expensive. The refinery earns more when fuel is expensive, and the passenger pays more because fuel is expensive. Same cause, two people at the table, and only one of them is you. Average domestic airfare that May was up around 27% from the year before. That's not a rounding error. That's the family that saved all year to fly out and see a grandmother, quietly paying more, while the company that sold them the seat books a benefit on the very thing that made their ticket cost more. And I want to be fair here, because if I'm not fair, this stops being reporting and becomes noise. Delta has a real defense, and it goes like this. Every airline is raising fares right now. Everyone passes fuel costs through. That's the industry. That's the model. That's been true for 50 years. And without Trainer, they would argue, Delta would be raising fares even more, or cutting routes, or laying people off. That's not an unreasonable argument. It might even be true. But notice what it defends. It defends the fare. It doesn't answer the other question. If the refinery exists to shield the company from the pain of expensive fuel, and the company simultaneously hands 100% of that pain to the customer, then who, exactly, is being shielded? Not the passenger, the shareholder. And that's not a scandal. Nobody broke a law. Nobody lied. That's just a machine, doing precisely what it was built to do. If you've come this far into the video with me, I want to invite you to subscribe to the channel and come with us. We're here every day. And honestly, if you've stayed 25 minutes for a story about a refinery in Pennsylvania, you're probably the kind of person who worked out a long time ago that the important thing is never in the headline. It's in the footnote. It's in the part nobody thought was worth explaining. So let's go find the footnote, because there's one more piece of this, and it's the biggest one. That plant in Trainer doesn't just make Delta's fuel. More than half of the jet fuel on the entire east coast of the United States comes out of it. More than half. More than half. Think about what that actually means. Every plane lifting out of New York, out of Boston, out of Philadelphia, out of Washington, a huge share of the fuel burning under those wings is coming from one facility, on one riverbank. A facility a professional oil company had already given up on, owned today by a single private airline. And that stopped being theoretical in June of 2026. First, an internal leak forced Monroe Energy to shut down both of its distillation units. Days later, a fire broke out in a pump room. Workers were hurt. One was airlifted out with burns. And then the country felt it. Bastian said the incident added about 5 cents a gallon to their fuel cost, and that the plant was running at around 75%, with production expected to stay slow for months. An industrial accident at a private company's plant, and the price of flying in America moved. So here is where we've ended up. The most quietly consequential piece of infrastructure in American aviation isn't an airport. It isn't a control tower. It isn't a runway. It's a 90-year-old refinery on the Delaware River that an oil company threw away, bought on the word of a man the markets later banned for life. Nobody voted on that. Nobody approved it. Almost nobody knows it's there. There's one more thing, and then I'll leave you alone with it. Delta Airlines did not begin as an airline. In 1925, in Macon, Georgia, it was a crop dusting outfit. 18 planes spraying chemicals over cotton fields to kill a beetle called the boll weevil. That was a business, not passengers, not luggage, not tickets. Chemicals moved through the air onto something that couldn't survive without them. 101 years later, that same company owns a refinery, and half the East Coast can't leave the ground without what comes out of it. I don't want to make that sound like fate. It isn't. It's just a strange straight line that nobody drew on purpose. And him, he went to work at a refinery in Newfoundland. The man who was no longer permitted to trade paper went and stood next to the still. The actual still. Pipes and towers and fire on a cold coast, a long way from a Bloomberg terminal. I don't know what he was thinking. Nobody does. He doesn't give interviews. There's no memoir, no podcast tour, no redemption arc. He built the machine. The machine outlived him. That's the whole record. There's a version of this story where Delta is brilliant. A company humiliated twice by something it couldn't control, went out and bought the thing itself, held it through a decade of ridicule, and got proven right. That version is true. There's another version where a private company ended up holding strategic national infrastructure, earns more the more dangerous the world becomes, and hands the cost of that danger to the person sitting in 22C. That version is also true, both at once. That isn't a contradiction. That's just what power looks like from close up. Next time you're at 35,000 feet and the cabin lights go down and you look out at that wing, you'll know something almost nobody on that plane knows. That the fuel burning under it was probably made in Pennsylvania at a plant that was thrown away, bought on the word of a man who isn't allowed in the market anymore. And that somewhere, when the news gets worse, a number goes up, not yours. If this changed the way you look at something, follow the channel and send it to 5 people. 5. The ones who'd actually want to know how the thing works underneath. And leave me a comment, an honest one, not great video. Tell me what you want me to look into next. What company, what family, what empire. I read them. The next one usually comes from you, because there's always a footnote. There's always a man nobody names, and there's always a bill sitting quietly, waiting for somebody to pay it.